Introduction. Why some green card holders are growing increasingly concerned about bank transfers. $5,000. That was the amount one lawful permanent resident sent from his U.S. bank account to help his mother overseas pay for a scheduled surgery. He had lived in the United States for more than 15 years. He was a senior employee at a technology company. He paid his taxes every year, owned a home, and had renewed his green card once before without issue. Sending money home to support family was something he had done responsibly for years. This time, however, he decided to divide the total amount into two separate transfers spaced a few days apart. He had once heard that keeping transfers under the limit reduced scrutiny. He thought he was being cautious. What he did not realize was that intentionally dividing financial transactions to avoid perceived reporting thresholds can sometimes trigger greater attention under federal compliance rules. Several weeks later, his bank temporarily restricted his account while conducting a review of recent transfers. At the same time, his green card renewal application was pending. During routine background screening, the financial compliance flag appeared in federal databases. Although no criminal charges were filed and his money was lawful, the review process led to months of delay, legal consultation costs, and significant stress for his family. It is essential to say clearly, sending money to family members abroad is completely legal. Supporting relatives financially is lawful and common. The issue is not the money itself. The issue is how certain transaction patterns interact with financial reporting systems that operate automatically and quietly in the background. In 2026, financial institutions operate under strict federal reporting obligations. These systems apply equally to U.S. citizens and lawful permanent residents. Understanding how they work does not mean you are doing something wrong. It means you are protecting yourself from avoidable misunderstandings. How financial monitoring works in the United States. There are multiple overlapping legal frameworks requiring banks and financial institutions to report certain types of transactions. These systems were designed to combat money laundering, fraud, and financial crime. They operate automatically and are driven by thresholds and behavioral patterns, not personal context. Currency Transaction Reports, CTRs. Under the Bank Secrecy Act, financial institutions must file a currency transaction report whenever a customer conducts cash transactions exceeding $10,000 in a single business day. This includes deposits, withdrawals, or exchanges involving physical currency. A CTR is not an accusation of wrongdoing. It is a routine reporting requirement. Many legitimate business owners and individuals trigger CTR filings without consequence. The report simply documents that a large cash transaction occurred. Problems arise when individuals attempt to avoid CTR filings by dividing cash deposits into smaller amounts. That behavior, if done intentionally to avoid reporting requirements, can fall under the legal concept known as structuring. Suspicious Activity Reports, SARs. Suspicious activity reports operate differently from CTRs. Banks must file a SAR when they suspect that a transaction pattern may involve structuring, fraud, or unusual activity. There is no minimum dollar threshold required. A $500 transaction could theoretically generate a SAR if it appears inconsistent with your normal account activity. Banks rely on automated monitoring systems that evaluate frequency of transfers, size deviations from historical averages, geographic destinations, rapid movement of funds across accounts, repeated transfers just below known thresholds. If the automated system detects something unusual, compliance officers review the account. If they determine the pattern may warrant reporting, they are legally required to file a SAR with the Financial Crimes Enforcement Network, known as FinCEN. Customers are not informed when a SAR is filed. Expanded data sharing and immigration screening. Federal agencies have increased interagency data coordination in recent years. Financial reporting data may be accessible during broader background checks for immigration benefits, tax reviews, or regulatory investigations. This does not mean that routine remittances automatically create immigration violations. However, when someone applies for a green card renewal, naturalization, or other immigration benefit, background screening may include compliance databases. If a SAR exists, it may trigger requests for clarification. Understanding, structuring clearly. Structuring refers to deliberately breaking up transactions to avoid triggering mandatory reporting requirements. For example, Depositing $15,000 in cash is legal and will automatically generate a CTR. Dividing that deposit into two separate deposits of $7,500 with the intention of avoiding a CTR may be interpreted as structuring. The key issue is intent to evade reporting requirements. Ironically, filing a CTR for a legitimate $15,000 transaction is safer than creating a pattern that appears evasive. Many individuals mistakenly believe that staying under $10,000 guarantees privacy. In reality, repeated deposits just under reporting thresholds often receive greater scrutiny than a single transparent transaction. Wire transfers and pattern deviations. While $10,000 is widely known as the cash reporting threshold, wire transfers are evaluated differently. Banks analyze whether transfers of $5,000 or more deviate significantly from your established account history. If your account typically shows modest monthly transactions and you suddenly initiate a large international wire, the system flags it as unusual. The transfer itself may be completely lawful. However, the deviation from your historical baseline can generate a compliance review. If the bank cannot easily reconcile the deviation, it may file a SAR under the category of unusual activity. Foreign accounts and FBAR obligations. Green card holders are treated as U.S. persons for tax purposes. If the combined value of all foreign financial accounts exceeds $10,000 at any point during the year, even briefly, you may be required to file a foreign bank account report, FBAR. The FBAR is filed electronically with FinCEN. Civil penalties for failing to file when required can be substantial, even when the funds are legal. Complications sometimes arise when individuals wire money from U.S. accounts into foreign accounts that are disclosed on an FBAR. If the transferred amounts and reported balances appear inconsistent during later review, questions may arise. Often these inconsistencies are innocent and caused by exchange rate fluctuations or timing differences. However, without documentation, they can delay immigration or tax processes. Payment platforms and 1099K reporting. Payment platforms such as PayPal, Venmo, and Cash App are required to issue Form 1099K once certain thresholds are exceeded. These reports are sent to the IRS and create an aggregated record of payment activity. When someone regularly sends significant sums domestically to another individual who then forwards money internationally, the layered transaction chain may resemble what compliance systems classify as layering. Layering is a technique used in financial crimes to obscure fund origins. Most family remittances are lawful, but repeated high-volume patterns across linked accounts can attract automated review. Remittance services and geographic monitoring. Money transmitters operate under federal compliance requirements. Certain geographic targeting measures may require additional identification collection and reporting for transfers above specified amounts to certain countries. Again, this does not make remittances illegal. It simply increases documentation requirements. When cumulative transfers exceed certain annual levels, the aggregated data may enter review systems. Common triggers for additional scrutiny. Splitting transfers to remain under thresholds. Sudden large deviations from prior activity. Missing FBAR filings when required. Inconsistent documentation between tax returns and transfers. Layered transfers through multiple accounts. These patterns do not automatically lead to immigration penalties. However, they can result in temporary account restrictions or requests for clarification during immigration benefit processing. Protective steps for green card holders. First, do not divide transfers to avoid reporting. If you need to send a large sum and the funds are legal, send it transparently through official banking channels. Second, maintain thorough documentation. Keep records explaining the purpose of transfers, such as medical invoices, tuition statements, or written family support confirmations. Third, ensure compliance with FBAR requirements if you maintain foreign accounts. Consult a licensed tax professional if you are uncertain. Fourth, use clear memo descriptions in bank wire transfers. Descriptions such as family medical support or educational expenses create context within the transaction record. Fifth, consult professionals before making significant transfers if you have pending immigration applications or complex foreign financial holdings. Understanding the real costs. Temporary account reviews can affect joint bank accounts, mortgage payments, educational savings, and family stability. Even when no wrongdoing occurred, Resolving compliance reviews may require legal assistance. Legal consultation fees can reach several $1,000s. Immigration application delays can extend for months. The emotional strain of uncertainty can be equally heavy. Key reporting figures to remember: $10,000. Cash transaction reporting threshold. $5,000. Common wire review threshold when inconsistent with account history. $10,000 aggregate. FBAR reporting requirement for foreign accounts. 1099-K thresholds. Payment platform reporting triggers. These are reporting thresholds, not prohibitions. Final perspective. Green card holders have the legal right to earn income, pay taxes, and support family members abroad. There is nothing unlawful about responsible remittances. The true risk arises from misunderstanding how automated financial compliance systems interpret patterns. Transparency, documentation, and regulatory compliance are the strongest safeguards. Being informed today can prevent significant financial and immigration stress tomorrow.